Hello and welcome to our July market evaluation webinar, which of course this quarter is going to have quite a strong Brexit theme throughout. These webinars are hosted each quarter and are designed to provide an update on what has happened in the financial markets over the last quarter and how those changes have affected the expected returns and portfolios that are updated each quarter based on the eValue asset model insight. With me today are Mark Grimes, eValue's Product Director, and Salman Ansari, a senior member of the eValue asset modeling team. Before I hand over to Mark and Salman, throughout the webinar, if at any point you have any questions you would like to ask, please use the questions feature within your GoToWebinar window and we'll answer these at the end of the session. I'll now hand over to Mark to provide an overview of eValue's approach to asset modelling.
Thank you, Ben. Markets were clearly not expecting the results on the 24th of June to be a vote to leave the EU and reacted with volatility to news of Brexit. Our model takes current market conditions as an input into the calibration assumptions, and we updated our model for conditions at close of business on the 24th of June and issued these as an interim update to show the potential direction of travel. This webinar publishes our regular quarterly update for the quarter ending 30th of June, but on an accelerated schedule compared to usual to reflect the changes that have gone on in market conditions. The eValue asset model insight is an economic scenario generator. That is, the output is many thousand different paths of how economies in the world might develop and the asset returns from major asset classes associated with each of those scenarios. Those scenarios are then used across all of our tools and applications in order to provide projections and optimize portfolios. eValue have been modeling investment markets since 1993, and we've got over 20 years experience of building economic scenarios. The purpose of these quarterly updates is to provide financial advisors with some commentary on investment markets and the background to quarterly changes in asset allocations. We stick to a medium to long-term view. And that's probably quite important this quarter round because clearly things are happening on a very short-term view, and the market conditions today are almost certainly not the same as they were last week, and who knows what they'll be next week. But our view is to stick to a medium to long-term view whilst actually taking into account where the market is currently. So, for example, at the present time, we recognise that record low interest rates mean that future income returns will be meagre, at best possibly, but a return to high interest rates has the potential to create havoc and substantial losses. But we've also got to consider the fact that actually interest rates may not have reached their bottom, that potential negative interest rates in the UK and weak productivity growth may mean that rates could stay low or in fact even go negative, and that bond investments may not be such a bad thing after all. Key requirements for our economic scenario generator. Fundamentally, any model must be fit for the purpose for which it's used. And this may seem like an obvious statement, but for the purpose for which we use the model, this gives us 6 key things that we have to actually build the model for. The purpose of the model is to look at the long-term risk and reward behavior of assets in the hands of an investor. For this purpose, we're considering the outcome of investments to achieve investors' goals. And for example, asset returns are of little value if their purchasing power is eroded by future high inflation. So inflation needs to be an integral part of our model. Similarly, many investors' long-term goals are for income. So we build a model that generates both income and capital growth and combines them to a total return. So for example, current calibrations will show very low income returns on fixed income investments. A consumer is typically investing now, so are exposed to current market conditions. So our model needs to reflect current market conditions, and this is the driving reason why we update it on a quarterly basis. Investment markets and opportunities are global. So to reflect the breadth of opportunities around the world, we have a consistent global model for all our investment markets and an exchange rate mechanism between them. Finally, our model reflects the fact that different investors have different time horizons and that the risk of different asset classes varies by time horizon. Holding cash is clearly the lowest risk asset class to hold this month if your time horizon is over the short term. But as time horizon increases, so does the uncertainty of the total return that you might achieve from cash. and the total return or the certainty of the total return that you'll receive from a bond reduces. Our model reflects this real risk behavior over time. The model structure I will not go into detail today, but basically I'll say at the center of this are the two assumptions that we can model the interest rate, real and nominal interest rate yield curve, and that we start from a current situation of those interest rate curves. Everything else builds up from that. And when I hand over to Salman for some commentary on the investment market, we'll be focusing on interest rates because they are the primary driver behind the changes in this update. Finally, just 4 key concepts and where they fit in with this update. We have a model calibration, which are the parameters that are fitted to the economic models. We update these annually. We're not updating that this quarter, so they stay the same. But we use a state space approach. That is, the model develops time period on time period from where it ended up in the previous time period. Critically, it develops from now. So we need to take the starting state of the economy into account now, which is why we update them quarterly. Update quarterly are a trade-off between chasing our tails for every change in market conditions and not reacting quick enough. Despite the changes for Brexit, we propose to continue to update quarterly, but we will keep that under review. And that is, for example, the reason why we issued an update based on the 24th of June. Now, responding the day of the vote is a little bit meaningless in terms of our going back to the long-term conversation or long-term position that we were taking previously, in the markets didn't have a chance to actually settle down after what was an unexpected result for the markets, which is why we issued it as a direction of travel and not something that should be implemented. We've accelerated this quarter's update so that actually we can update it based on what we hope is a reasonably stable expectation from market conditions of what the market knows about this. Clearly, if things change, who knows what will happen over the next 3 months with various leadership challenges and all the rest of it. If things change then and it changes the calibration significantly, we will issue an interim update again. So with that, I'll hand over to my colleague Salman to talk you through the changes in the quarterly calibration for market conditions and their impact on expected long-term returns and portfolios.
Thank you very much, Mark. In this part of the webinar, we will look at how the economic indicators have changed over the quarter and how these changes are reflected in our asset model in the form of changes to returns projections. We will also summarize what has happened over the past quarter and say a little bit about where we think we're going next. So as we've noted already, interest rates are the cornerstone underpinning asset price movements. So we will start with these and then move on to the other assets. Along the way, we will also talk about Brexit, as that is the running theme in this quarter's update, what its implications are and what it means for our model and returns. So it has finally happened. The UK has voted to leave the European Union, the so-called Brexit, and markets have plunged into turmoil. Before the vote, GDP growth was already slowing. Inflation remains stubbornly low, and the UK current account deficit is now at its second highest level since the Second World War. Enter the Brexit vote, and there has been a strong reaction from the market. Even though no treaties have been undone, and the government is yet to formally trigger negotiations to leave the EU, the so-called Article 50 of the Lisbon Treaty, there has been a strong reaction from the market, and the result has undoubtedly created significant new uncertainty. The pound has plummeted to a 31-year low against the dollar, and as of this morning, it is also at its lowest level against the euro since 2013. Interest rates have also fallen sharply. The stock market has nosedived and only staged a partial recovery. It appears that the Leave camp had put more effort into getting the Leave vote than planning how to leave, and this has thrust the market further into uncertainty. Several resignations later, the political outlook remains uncertain, and the two main political parties are knee-deep in leadership battles at the moment, which only serve to feed the uncertainty in the market. Although there were signs that the markets had been incorporating the possibility of a vote to leave the EU into prices for some time before the poll, it is fair to say that the results took the market by surprise, and shares, interest rates, and the pound all fell sharply on the news. The move in interest rates stuck, bringing new record lows. The Bank of England moved in quickly to try and pacify the market, signaling possible assistance to the tune of about £250 billion for banks over the summer. For a moment, after Mark Carney's speech last week, where he mentioned the possibility of lowering the Bank of England base rate, nominal yields even turned negative for the first time ever. In other news, Standard Life suspended trading its £2.9 billion commercial property fund yesterday due to a sharp increase in redemptions as it ran out of liquidity on the back of uncertainty for the UK commercial real estate market. So let's have a look at interest rates. Rates in the UK and the US didn't change much for most of the quarter, but then went through a sharp fall at the end post-Brexit vote. 10-year yields in the UK are now well below the 1% mark, and just this morning they have dropped even further and were trading at 78 basis points at one point. Having gone negative for the first time last quarter, Japan is now leading from the bottom, with most of its yield curve now firmly negative. It has now surpassed the prevalent negative rates that we have seen in several European countries, notably Switzerland, Sweden, and Germany. Germany and France have also mirrored the trend that we've seen in the UK and US, but at a lower level, with similarly vacillating yields over the period. Germany has responded more acutely to the Brexit vote from the negative pressure of the UK leaving. Yields in Italy and Spain rose following the Brexit vote, reflecting the expected effect on the EU of Britain leaving. The quarter ended with yields halfway between the UK and US levels. Greece has also responded very similarly to UK and US, and more so Germany and France, but at a higher level, again reflecting the uncertainty associated with Britain leaving. The upshot of all of this is that lower rates make our projections for fixed income returns even lower. We have also lowered the floor on UK rates to -1%, which has increased the risk of UK fixed income assets. This last point deserves some more explanation. While negative rates are very much a reality, they cannot be indefinitely negative for a physical currency. For this reason, we have a floor which we have traditionally set at 0. And once we have negative rates, we're likely to have a floor that is negative, but one which is definitely there to prevent them from exploding to unrealistic negative levels. The possibility of negative rates, however, means bond returns are more volatile and expected returns are lower. In this update, in line with market conditions, we have lowered the rate floor for the UK, EU and Japan to -1%. And this has the desired effect of increased risk and lower returns for fixed income type assets. Next, we'll move on to real rates. Real yields are firmly negative and have become significantly more so since the Brexit vote. The macroeconomic meaning of negative real rates is that either the expectation is that nominal rates will remain low or go lower still, or that inflation is expected to rise faster than nominal yields, or possibly even some combination of the two. We will discuss this in a bit more detail later. Suffice to say, lower real yields means that real returns continue to be hard to come by, and prospects for index-linked bond returns at the quarter end are much worse than they were at the start. We'll now move on to equities. There has been notable movement in equities post-Brexit vote, there was a sharp drop followed by some sort of a recovery. Volatility indexes shot up prior to the poll and have remained elevated, signaling that uncertainty is the main investor sentiment at the moment. Overall, the equity indexes have vacillated over the quarter, rising in the lead to the EU referendum and then falling dramatically. Since the crash at the end, the equity markets have staged some sort of a recovery, but to various levels. The quarter ended higher for the FTSE 100, but this has a caveat which we'll go into a bit later. Also note that these charts show total returns indexes as opposed to just price level. The stock markets that we have shown so far are in their local currencies. So for the UK it is in pounds, for the EU it's in euros, and for the US in dollars. To see the effect that a US dollar investor, for example, sees when they invest in an equity, we should look at these stock markets in a common numeraire. So let us first have a look at exchange rates against the US dollar over the past period. Note that we are showing exchange rates relative to their values at the start of the quarter and not actual exchange rates. At the end of the quarter, the US dollar has strengthened significantly with respect to the pound, meaning the US dollar investor has a favorable exposure to downside movements in the UK, but realizes less return when the UK market gains. While the pound is trading very low against the dollar, at levels seen more than 30 years ago, it was in fact 131 this morning, some analysts are predicting a drop to 125 by the end of the year. So if we have a look at the previous total returns indexes, but in dollar terms, you can see what a dollar investor would see over the past quarter. Notwithstanding the tumult caused by the Brexit vote, the US dollar strengthening against the pound means that UK equity returns over the quarter are perceived lower. The upshot for equities, therefore, are deteriorated asset returns prospects over the quarter. This is also a good place to make a quick note about property. Prospects for property assets were relatively subdued as much of the yield has already been realized. Recently, the Brexit vote has worsened prospects as investors are now worried about vacant commercial property and flight of capital has ensued. As we mentioned earlier, Standard Life suspended trading in its commercial property fund yesterday as cash for investor redemptions was running out, which is in line with our outlook for property in the short term. Before moving on to the effect on asset returns in our model, we'll discuss Brexit and its implications. As we are all aware, the result of the EU referendum has created quite a bit of tumult in the market. Stock markets can be an indicator of the health of the economy, but there are a number of caveats with that statement. If we were to listen to the news only, all we seem to hear is that the stock market fell in the immediate aftermath of the Leave vote, but has since recovered. In pound terms, that is. What most fail to mention is that the pound is trading at a 31-year low against the dollar, and this has a profound impact on the health of the stock market. Stock market indexes are traditionally quoted in their native currency. So the FTSE 100, for example, is quoted in pounds. Another caveat is that most of the FTSE 100, in fact more than 75% of it, is invested overseas. So the chart that we're looking at the moment is what the stock markets for the UK, US and EU look like in pounds, dollars and euros respectively. Here we're showing the price levels as opposed to the total returns levels that we showed earlier. The FTSE 100 has recovered from the slump post-Brexit, even more than the S&P 500 has, or the Euro Stoxx 50. Having said that, more than 50% of the FTSE 250, which we are also showing on this chart, is also invested overseas. So even that is a poor indicator of the UK economy, having fallen more than the FTSE 100. So from if we have a look at what this looks like from a pound perspective, the current chart shows us that the S&P 500 is the clear winner. The weak pound means that the US market has seen more than a 10% rise in the last week alone. The weakening pound against the euro also means that the Euro Stoxx 50 index appears to have completely recovered from the post-Brexit slump. But this is not the whole story. For someone outside the EU, for example, a dollar investor, the US dollar perspective shows that the FTSE 100 has not recovered yet, and in fact is trading at almost 8% lower than the day of the EU referendum. The story is similar for the Euro Stoxx 50 index. The FTSE 250, which saw a dramatic fall post the Brexit vote, was at 1.25% lower than on the day of the referendum and is currently still trading well over 15% lower. The fact that the UK stock market is open to foreign investors and that the pound is significantly cheaper now, the failure of the FTSE 100 and the FTSE 250 for that matter to recover lost ground from pre-Brexit levels means we cannot draw much comfort in the state of the UK economy currently. A fall in currency is usually positive for shares. A fall in interest rates is also positive for shares. So if the FTSE 100 stays down, then we are not doing so well. The details of the Brexit deal are yet to be worked out, but if the FTSE becomes more British after this transition, then we may lose even more, as this will be worse for the UK market. Now we'll have a quick look at what equity market volatility looks like, as this is an indicator of investor sentiment and the uncertainty that is in the market. As we've noted already, uncertainty is running at a high currently, and this can be seen in the volatility indexes. In the lead up to the EU referendum, the result appeared too close to call, and the UK and EU equity volatility indexes shot up to levels seen last summer in the wake of the Chinese stock market collapse. Peaking earlier in June, when the Leave camp appeared to have a lead over the Remain camp, but since the Brexit vote over 10 days ago, the volatility still remains elevated. So the main message that we can get from these indexes is there's still uncertainty in the market. In fact, that is the main message in our update, that the future is quite uncertain and our asset returns are reflecting that. Another thing we can look at is actually interest rates post-Brexit. Interest rates show another side of the health of the economy. We can infer inflation expectations from the spread in levels of nominal and real interest rates, the so-called break-even inflation. In the run-up to the Brexit vote, real yields were generally stable, and most of the movement in the spread was due to volatility in the nominal yields. Since then, however, both nominal and real yields have fallen sharply, real yields more so than nominal yields, signaling that the market is expecting higher inflation or lower yields. Inflation expectation as a result has risen sharply, as we can see from the chart. With the pound falling, imports will become more expensive over time, and this will apply inflationary pressure. In any case, expectations for positive returns are weak. We'll now move on to asset returns. The main take-home from the discussion thus far is that prospects have deteriorated over the quarter. Equities are down, and declining rates and lower inflation pressures have depressed fixed income returns. Outputs from our model reflect these observations in the asset returns projections. We will demonstrate these by way of tilt charts. These show the change in asset returns over the quarter at various time horizons. So if we look at the chart that we can see right now, a movement to the right indicates an increase in risk, while a movement upwards indicates an increase in return. So the best improvement is in the top left quadrant, where we have more return at the cost of less risk. And the worst change, on the contrary, is in the bottom right quadrant, which is an increase in risk but a decrease in return. At the relatively short time horizon, in this case 8 years, all asset returns movements are in the bottom right quadrant with respect to what they were at the end of March, showing an increase in risk at the cost of a greater decrease in return over the quarter. Cash and fixed income are more well off than equities, and property has taken quite a hit over the quarter. If we look at the slightly longer term, for 18 years in this case, the situation is very much the same. Assets have increased in risk but decreased in return. This has a knock-on effect on the allocation changes since April. And by way of an example, we'll show one of those portfolio changes. In this case, what happened at a time horizon of 13 years. In light of the above, we have relaxed the constraints on our property and overseas equity assets to better reflect expected market movements. The allocation changes from the last quarter show movement out of property and out of domestic equity into overseas equity, which is in line with what we broadly expect from current market conditions. We'll round up this webinar now with a brief look at the quarter-to-date performance. As we have noted earlier, there's a marked decrease in returns, but an increase in risk for fixed income type assets, so cash and all the other fixed income type assets. Equities have also shown a drop in return, but for a smaller risk penalty. And that brings us to the end of our webinar today.
Okay, thank you, Salman. Just to round up on that, we have updated the normal reports that we produce for the portfolios and the asset returns, and they will be being distributed around shortly. They will contain a commentary on the changes to the portfolio asset allocations that Salman had touched on briefly there. But I think it's worth highlighting two key elements that have come out of that. One of them is a reduction in property allocations. Now, historically, property has always been a very positive asset class to have within a diversified portfolio. It provides an element of diversification due to not being correlated to, or not being strongly correlated to other asset classes. It is, however, a liquid, or can be a liquid, as Salman had highlighted earlier in the presentation. And for that reason, we've actually always capped it out at 10%. Now, practically what that means is that our asset allocations always hit the cap on property. This time round, the property allocations have fallen and in fact have come out completely from some of the portfolios. Now, we are very cautious about changing property allocations within these portfolios because property is an expensive asset class to trade in and out of. However, this quarter there is material enough changes that it didn't feel appropriate to continue for new money to have money going into property, which is not justified by the optimization. So you will see changes to the property allocations across all of those portfolios. There is clearly a very practical issue about existing portfolios and how you manage those in, how you manage a transition, which we are conscious of and will be updating those property allocations quarter on quarter to make sure that there's a degree of stability around them which still reflects the reality of those property returns. The other change that you'll see is that we have historically enforced or maintained a home market bias. So the fact that UK equities for a UK investor would be the market of choice, or the one that would have the biggest allocation to it. What we've done this quarter is we've relaxed any constraints on that and allowed actually the market expectations to determine those asset allocations. Now, what that does is it moves out of UK equities into global equities. The primary function of that, or the primary reason for that, is not that we are pessimistic on UK equities, but that actually it allows you to achieve a greater global diversification around those. And in fact, you can see that with some of the returns that have come through on the UK equities, in the FTSE 100, which dominates the UK equity market, is not really a UK equity market. It's really just a subset of global equities, focused on international mining stocks, some drug companies, and a couple of oil companies. So actually opening that up into a global market allows greater diversification. We will keep both of those under review. The other bit that we will be reviewing, we haven't changed it this quarter, but it is something that is definitely under review, is what to do with low risk asset classes, in that we have government bonds in there, but as those yields trend down towards zero, what else can we put in the low risk asset classes? Now, within the optimization, we do include high yield global bonds, and we do include developed market government bonds within the optimization. However, the basic optimization itself will not actually include those asset classes, because basically the expected return is not high enough to compensate for the currency exposure risk that is associated with those. And indeed, if you look at global government bonds, the two very significant markets in there, Germany and Japan, are trading negative. And in fact, there's something like $9 trillion worth of global government bonds which are trading at negative yields at the moment. So clearly the expectations within those markets are, or the expected returns that we can get within those markets, mean that they don't appear within the portfolios. It is something that we will keep a watching brief on, as always, but certainly there are challenges at the moment around finding an acceptable return for a low volatility asset class. So with that, as there's no further questions that have come through, we'll thank you all for listening, and we'll close it there.